If you don't have a health savings account, you're missing out on one of the best tools available to lower taxes and build a long-term wealth. If you already have one, you might not be using it to its full potential, because by the end of the video, you will know 4 simple but overlooked ways to use an HSA to make you rich. And I will explain how it works as an active accountant and tax strategist at keepmost.com, starting with what an HSA even is. You see, an HSA is short for Health Savings Account. It's a tax advantage account designed to help you pay for healthcare costs. It's available only to people enrolled in a high deductible health plan. These are health insurance plans that trade lower monthly premiums for higher out-of-pocket costs when you receive care. If you're not sure whether your insurance qualifies, check your plan details for words like HSA eligible or high deductible health plan. Now, once you're enrolled, you can open an HSA through a bank, a credit union, or an HSA provider like Fidelity or Optum. From there, you can deposit money into the account, let it grow, and use it for qualified medical expenses tax-free. That's the basic definition. But the real power of an HSA comes from its triple tax advantage. So let's go over the 3 huge benefits. You see, most financial accounts give you 1, maybe 2 tax benefits, but an HSA gives you 3. First, you get tax-free contributions. The money you put in it is deductible from your income. In plain terms, this means you don't pay taxes on the amount you contribute. Second, you get tax-free growth. You can invest your HSA funds in mutual funds, index funds, or even ETFs. And the best part is that any growth, dividends, or capital gains that occur inside the account are not taxed. And third, you get tax-free withdrawals for medical expenses. So when you use your HSA funds for qualified healthcare costs, things like doctor visits, prescriptions, dental work, or vision care, you don't pay taxes on those withdrawals. Few other accounts, if any, combine all 3, and that's what makes the HSA unique. In short, money goes in it tax-free, grows tax-free, and then comes out tax-free. Now, there are a few contribution limits you need to be aware of. You see, each year, the IRS sets a limit on how much you can contribute to your HSA. So for 2025, or what's remaining of it, the limits are $4,300 for individuals and $8,550 for families. Now, for 2026, the limits will increase by $100 for individuals and $200 for families. If you're 55 or older, you can contribute an extra $1,000 each year as a catch-up contribution. Now, these limits typically increase slightly every year to keep up with inflation. And now that you know if you can use an HSA or not, let's go over what you can use an HSA for. Like we discussed earlier, your HSA funds can be used for a wide range of qualified medical expenses. These include doctor visits, hospital visits, prescriptions, physical therapy, dental work and orthodontics, vision exams and glasses, some over-the-counter medications, and many health products like the 8-Sleep bed. Now, you can find the full list in IRS publication 502, which defines exactly what counts. If you use your HSA for non-qualified expenses before the age of 65, you'll owe both income tax and a 20% penalty on that withdrawal. After 65, that penalty disappears. You just pay income tax similar to a traditional IRA. And that's why many people treat their HSA as both a health account and a long-term investment account. Okay, now that you know the basics, here are the 4 strategies that can make your HSA far more effective in helping you build wealth. Hack number 1 is to invest your HSA funds. You see, most people don't realize they can invest the money sitting in their HSA. Keeping it in cash earns next to nothing, usually under 1%, and inflation quickly erodes that value. Most administrators like Lively, Fidelity, or Optum let you start investing once you've reached a small minimum balance. You can choose from index funds, mutual funds, or ETFs based on how comfortable you are with risk and how long you plan to let it grow. Now, here's why that matters with a quick example. You see, we have John, who only saves. He maxes out his HSA each year for 25 years and leaves it in cash. That account ends up around $111,000. But Sarah, who invests instead, earns roughly 7% per year and ends up with $258,000. That's over $150,000 extra in free cash because she invested it instead of leaving it in the account. Now, hack number 2 is don't spend from your HSA. It sounds odd, but try not to use your HSA for medical bills if you can afford to pay them out of pocket, because every dollar you leave invested keeps compounding and compounding. You see, a $1,000 expense left invested for 25 years at 7% turns into more than $5,000. If you withdraw every time you have a bill, you lose years of compounding and potential growth. If money is tight, use it, right? That's what it's there for. But when possible, let the money grow tax-free. And speaking of tax-free, did you know that an HSA account is one of 90+ strategies to save on taxes and grow your wealth? Just go to keepmost.com and let AI help you save on taxes. It's the most affordable way to get a CPA level tax plan in less than 30 minutes without the cost of a CPA. Hack number 3 is to reimburse yourself later. You can reimburse yourself for qualified medical expenses whenever you want, as long as the expense happened after your HSA was opened and you keep the receipt. So here's what that looks like in practice. That means you could pay for a procedure today, leave your HSA invested for decades, and pull out the same amount tax-free years later. That one trick there lets your balance grow while giving you flexibility in the future. Just save your records, your receipts, invoices, statements, so you can prove the expense if needed. Now, hack number 4 is to treat it like a retirement account at 65. Once you reach 65, your HSA becomes even more flexible. You can withdraw funds for any purpose and not just medical costs. At that point, your HSA can act like a traditional IRA. Now, we need to talk about managing the account wisely. So here are a few simple practices that can help you get the most out of your HSA. First, contribute consistently. Even small, regular deposits build up over time. And avoid early withdrawals. The longer your funds stay invested, the more tax-free growth you capture. Next, review your investments. Choose broad, low-cost funds and rebalance occasionally. Then track your receipts digitally. Store them in a secure folder or app so you can access them later for reimbursements. And lastly, know your provider's rules. Some require a minimum cash balance before you can invest or charge small monthly fees. Now, you may be wondering, how does an HSA interact with Medicare? There's an important rule to remember about HSAs and Medicare. Once you enroll in any part of Medicare, including Part A, you can no longer contribute to your HSA. You can still use the money already in the account, but new contributions must stop. And Medicare coverage is often retroactive for up to 6 months, which means you need to plan ahead here. If you're approaching age 65, it's smart to stop contributions a few months before your Medicare effective date to avoid tax issues or any penalties. You can still use your HSA to pay for Medicare premiums, except for Medigap, deductibles, and other out-of-pocket expenses in retirement. Now, overall, here are common mistakes to avoid. First is using it like a checking account. Constant withdrawals prevent long-term growth, so use cash for smaller medical bills if you can. The second mistake is not investing the balance. You see, leaving everything in cash wastes one of the account's biggest advantages: tax-free growth. The third mistake is losing receipts. Without proof of your expenses, you can't reimburse yourself later tax-free. The fourth mistake is contributing after enrolling in Medicare. This is one of the most common errors and leads to taxes and penalties. The fifth mistake is ignoring fees. Some administrators charge monthly or investment fees that can eat at your returns. Always compare options. So I think I made a good case for the HSA needing and deserving more attention. The HSA isn't flashy. A lot of people don't talk about it. It doesn't come with an employer match or a big promotional campaign, but the combination of tax savings, investment potential, and flexibility make it one of the most efficient accounts available. And you might not know, but it's also portable. Your HSA belongs to you, not your employer. So you can take it with you when you change jobs, retire, or move. Now, like I mentioned, it is one of 90 plus strategies that you can use to save on taxes and grow your wealth. Just go to keepmost.com if you want to see the 90 strategies and how they apply to your unique situation, so you can see exactly how much you can save. I hope you enjoyed the video. Give it a like so it reaches more people. And as always, my name is Karan, and I'll see you in the next video. Take care.